Hey everybody, hey traders, Chris Pulver here just after 9 p.m. Eastern Time on Sunday the 18th. I want to do a little weekly video for some key levels on the S&P 500 coming into last week. So Sunday to Monday, we had a huge gap in the futures market. So basically it was a 1-minute candle. You can see this here. This is the 3 a.m. announcement where U.S. and China agreed for another pause in tariffs, plus they de-escalated the percentages. You can go down to a 1-minute time frame and see that that was a monster candle, and that momentum did carry pretty much the end of the week. So here we are, about 3% to just over 3% to getting back to all-time highs. We do have some pretty severe maybe pullbacks coming, which I mean, as somebody that wants to buy this market, I'm kind of hoping that we get a pullback. I would say with this amount of inefficiency in this market's run, I do think there are reasons to give us some pullbacks. I would say that the bulls could even pull back or even see the bears pull back about 10%. I'd love to see about a 3% pullback. 3 to 5% would be pretty ideal for me to start doing some positioning. If we pull back 3, 5, even up to 10%, let me go ahead and mark some of those positions here. So if we pulled back, let's go here. So from this close on Friday, we pull back about 2.6%, 2.65%. That gets us back to the Monday open. We pull back a little bit deeper than that. We're getting into the 3.6 level. A previous close to fill that gap entirely is about 4.5%. So like I said, about 3 to 5% would be a reasonable pullback. Perhaps with the Moody's downgrade on Friday, the market does get us there through an early pullback on Monday to Tuesday. I'm not sure what else is really happening this week. I mean, we've had the Fed, we've had earnings around kind of the downside of earnings season right now. For the most part, the market has clearly shown a lot of resiliency. I don't think that the Trump administration tariff talk is done necessarily. I think we might have a bit of an interesting news cycle to kind of get prices to pull back just a little bit. But like I said, 3 to 5% would be some attractive levels for me to start taking some bites. I really think this market could pull back even 10%, and I would still maintain a pretty bullish outlook. This gets us back around 6% to fill some gaps. We pull back into this area 8+%. Here's a gap fill between 9, almost 10%, and even 11%. I would still be pretty bullish even if we pulled all the way back here to around 5,300. Why would I be bullish there? Well, we're still on the backhand side of the trend line. I don't think that the April 7 lows are necessarily being tested again because, well, let's see what happens to the bond market. That's essentially what the flinch was when we had the bond market break. That all kind of happened with the U.S. 20-year yield and the 10-year yield spiking like they did in that 3 to 4 day trading range. We're creeping back up in the 20-year back up towards the 5% handle again. I think the U.S. bond market is in trouble, or at least spelling signs of trouble. So personally, I am getting rid of a lot of my bond exposure pretty aggressively. I own shares of TLT. I'm selling covered calls and working my cost basis down. But I have, I did have an outlook around like $95 to $96. Now I'm just happy to get out of it. I've got covered calls that just expired around $89, and I'm going to keep whittling it down. I have a $65 long call, and I sold the 95. Then I rolled it down, rolled it down, rolled it down. My last one was an 89. So my break even is in the low 80s. And I'm still sitting in some profit, but I'd like that to be, as aggressive as possible, trying to get rid of some of that bond exposure just in case we are going to continue to push a little bit lower in bonds and see yields drip a little bit higher. So if we go to US 10-year, here's the US 10-year. Not even close to Liberation Day lows when the market was breaking and tanking essentially. But how much higher do bond yields go? I'm not sure. The Fed is not likely going to cut until possibly September now. So we have this collision course between Donald Trump and Jerome Powell. We are probably hearing rumblings that the Fed is likely going to change the inflation target from 2% to possibly being more negotiable between 2 and 3%. Headline CPI is around 2.3 according to the last year-over-year print, which was this last week. All right, I think it was this last week because we had a CPI reading and PPI reading that were both kind of interesting. How it is showing lower inflation data, and then at the end of the month we have core PCE. So anyway, back to the bigger picture technicals. Let's take a look here. SPX. So like I said, a 3 to 5% correction is something that I'm kind of asking for, also looking for. If I don't get it, I mean, if the market does in fact just continue to go to all-time highs, I could see some backfilling in here. But this is also why I have on my blank workspace. If I go to this chart here, let me just open up my blank workspace. Give me 1 second. So blank, here we go, and go SPX. This one. So I'm just going to project some levels, and this is fairly conservative, but just hear me out. Let's say that the market does use this area as support. So we get to all-time highs, okay? We score a point for the bulls. The market consolidates, maybe pulls back a little bit. For whatever news cycle and catalysts that drive the market a little bit lower, we will see. But I still think that the market would struggle to make a lower low. So I'm looking at this kind of major area to be support in the markets. If we get up to recent highs or all-time highs and we pull back into here, I think it's pretty easy to see that if this is a neckline, left shoulder, head to neckline, right shoulder pullbacks, it's pretty easy to project, right? You go from one big swing, one big pullback, you swing this up to symmetry, and you're looking at some projection levels into the 66 to 6,800 zone. Obviously, 7,000 is a round number, so we can make that pretty textbook. I would say like up in here, it's like good enough for that cycle. If you also go to a higher time frame, like a monthly chart, it's very possible that we're heading up into a fifth wave, which would look something like this. We start from if we started here, COVID lows 1, 2, 3. Let's say this is wave 4. Well, that projected wave 5 would be somewhere up in here as well. So if I just take another long-term fib from the COVID lows, swing it up to that high in 2021, 2022, that's a projection up here around 6,400. So, if we have some pullbacks, I'm still interested in looking to go long. The recent rotation, a lot of it was utilities leading this year. Healthcare was leading until UNH has decided to be one of the worst performing stocks of the year. Financials are doing pretty well. Technology, I think, will still come out of it. I mean, this whole play with AI, growth is back in, momentum's back in. The U.S. is clearly, we're seeing Mag 7 perform well. Look at Mags, for example. Mags is performing pretty well on this comeback, just like everything else. So let's go to the daily time frame here. We are well above the 200 moving average and starting to break out of this trend line. Again, I wouldn't mind seeing some pullbacks. So if this is going to continue to go higher, I'd still like to see a pullback. Maybe we can run up, pull back to the backside of the trend line, find some gap and support in here, and then see if mags can get all the way back to these highs. If we have an aggressive turn lower on mags, I still like this area to dabble with some directional positioning. But anywhere in here or here or here, obviously the lows again, but mag 7 is still probably going to perform pretty well and be pretty stable. And if you're investing in the SPY, you're still investing a lot in the mag 7. Their price to earnings went from like 30 plus down to like 24 or 25. It was a pretty big reset there after they were down about 30%. But just like everything else, they did bounce back pretty aggressively. Stocks like Palantir, some of those big growth names also snap back very aggressively as well. So what to watch this week. I have been selling a lot of covered calls. Some of those include shares on IWM, shares on SPY, shares on IBIT, shares on Snapchat, shares on Pfizer, shares on Silver, shares on Baidu and Alibaba. I did close out some naked puts on AT&T. I have some Dow naked puts on DIA. Took some nice wins last week, had some earnings wins. So moving into this week, I'm really just going to watch some key levels, try to be somewhat patient. As much as I want to say we're going to all-time highs, I would sure like to have a pullback. So one of the trades that I took last week was just a naked put. I did a 475 naked put on the SPY. I did it out to December. So I did a 1231 put at 475. I also have plenty of hedges in the futures market. So if we do have a pullback, I'm going to show some drawdown in this, but I have some futures hedges on ES and MES that if we get back down into any of these gaps here, or obviously coming back to retest the April lows, those hedges pay really, really well just in case I need them. Otherwise, I'm still sitting in a decent amount of cash. About 55 or 60% of my portfolio is cash now, and I'd like to allocate it, but I'm just not ready to allocate on this. I wouldn't even call this a V bottom. I would say this is more, I suppose that is your V bottom because you do have a bit of a cup and handle pattern there. But if we go straight up here to the highs, is it possible that we don't revisit this area and we just consolidate at the highs and the market just keeps grinding and grinding and grinding? It's quite possible. If I go back again to that monthly time frame right here on SPX and look at a fifth wave, right? You take this fib from COVID lows, we project this up to a 618. Trading around 6,400, maybe that's the destination. And if we complete this kind of fifth wave move, I'd say between 6,400, obviously, 6,400 to maybe even 7,000 if the market just purely drifts higher. But I would still be expecting a 1, 2, 3 correction. back into this fourth wave high or even the fourth wave low. And that could make for an interesting 2026. So anyway, there's clearly a lot of volatility, a lot of uncertainty. A couple kind of bad news things to start us off this week. Friday's close, Moody downgrades the U.S. That happened back in 2010, 2011. The market did proceed a little bit lower. However, dollar position is different, rates are different. Are we actually going to see a 10% pullback? If we do, it actually still offers a pretty nice buying opportunity. On top of that, this could also be a nothing burger because nothing really changes. It's just Moody's is maybe this whole thing is long overdue. But on top of that, we have news out of the White House, or Scott Bessent is talking about, this whole detox period is still needing to happen. July is still this window where, what countries are going to line up behind the U.S.? Do we still have trade deals and negotiations to work out? We aren't really getting a lot of information from there outside of we are putting in kind of a good faith deal with the UK, which is one of the few countries we operate with a surplus with, and of course the pause with China. But there's still tariffs. I mean, we're essentially tariffing the world about 14%, and we're going to see where capital flows. And if capital is leaving the U.S., then I think there are other ways to participate. So you could do the let's see, S&P growth. S&P growth. I'm looking for, is it VOOT? I think it's total stock market. It's a Vanguard fund. Let me see here. Total stock market. There we go. VTI. So this is like 3,000 stocks. So if you wanted some exposure in non-US assets, this is one way to participate in that. I happen to be in one that is SCHY, and that is a Schwab ETF that is focused on Europe and China. And from that bottom that we had back in April, this has resiliently popped up here around 16%. So it's actually underperformed the recovery, even though the S&P is still 3% from all-time highs. We're still sitting at a slight gain for the year on S&P after all the drama in March and April. The Nasdaq is within also a whisper of those highs. So getting to the highs here, Nasdaq is about 3.67% away. The Dow is a little bit further to go, and the Russell is way further to go. But U.S. markets, looking to target those highs. I still like buying dips if we get them. I'm hoping that some of these gap fills and efficiencies will start to fill in this week or next week, maybe by the end of the month. And we'll see what June, July look like. So any type of backfilling, organized retracements would be nice. I would be allocating and adding some new option exposure. And that's going to be my plan here for the next week or two. So I hope that helps. Let's have everyone have a great week, and I'll talk to you soon. Thanks. Bye.